Do you worry about losing the money that you've put aside in your investment account? In this video, I'll share 8 ways that you can reduce your investment risk. Hi, I'm Camille Gaines. I'm a financial author, an accredited financial counselor, and most of all, I just share here what I've learned though from over 30 years of investing myself. I'm a little bit of a nerd around this, and I just enjoy sharing about it, writing about it. I write about it over my website, retirecertain.com, and I've got an ebook over there that you can grab that is on income streams and wealth building in the second half of your life. But in this video, what I want to do is share with you 8 things that I have found that there are great ways to reduce risk. Now, this video applies really a little bit more to stocks and bonds and traditional investing. I am a proponent of alternative investments as well as mainstream investing, because we found in later in life that creating alternative income streams from alternative investments served us well and allowed for an early retirement. So in this video though, I want to talk more about things that relate a little bit more to investing in stocks and bonds, because that's really what most people think about when they think about running out of money or their money in their retirement or investment accounts. And the very first thing that I'll share with you, first of the 8, is simply to increase the percentage that you have in cash. Now, traditional investing is usually something called asset allocation is done, where your money's divided up certain percentages between stocks, bonds, and cash. So that's usually based on, if you work with a financial advisor or you follow kind of a mainstream model, that's based on your risk profile, less so than what's happening in the overall markets. So what you can do is, if you're concerned that the markets might be overvalued, for example, you could increase the amount of money percentage-wise, and hence the amount of money you have in cash. That instantly lowers your risk. So that's idea number 1. And none of this is to be construed as financial advice. Only you know what's best for you. This is educational only. The second idea or way to lower your investment risk is simply to diversify. Instead of having everything in the stock market, for example, or everything in even real estate, for example, diversify among different types of investments. A real common way to diversify within stocks and bonds is simply to have U.S. Treasuries and stocks, because they are thought to be non-correlated or move in opposite direction, which doesn't always happen, but it usually does, because people tend to flock to U.S. Treasuries during times of financial uncertainty, and that's when the stock market's a little shaky. So have some investments that go up while other ones go down, or at least maintain their value while other investments are, moving all around. The third one I think might be my favorite way, and that's to buy cheap assets. You can do this by buying assets when they are undervalued. So a lot of people just take that asset allocation I mentioned, and they just go ahead whenever they get some money and place that money into the stock market or wherever it is, real estate market. But if you buy cheap assets, you're always going to lower your risk, simply because you have spent less. Your entry point into that investment is lower. So you can buy undervalued or cheap assets through funds, such as a contrarian fund, personally yourself by just paying attention to what's undervalued, or by working with a financial advisor that's a little more tactical, that really factors in market valuations in placing their clients' assets for them. So buying cheap assets is a great way to reduce your risk. The next way that you can lower your investment risk is simply to learn more about investing. So knowledge is power, right? And so the more you know about something, the more that you'll reduce your risk. You may think about the different things that that you have done in the past, and notice that the things that you knew more about, you just did better. It's no different with your money. So understand where your investments are. Understand what you're doing. Give your money a little bit of love and attention. Understand what's happening and learn a little bit about investing. The next thing I want to share with you is look at your investment risk versus your reward. So obviously it kind of goes without saying, but often it's forgotten or overlooked that the higher return, you're probably going to have more risk, and lower risk investments are going to have a lower return. So look at where you are now and think about has the amount of risk that you're able and willing to tolerate, is it still in alignment with where you were when you made certain investment decisions, or have shifts happened either in the markets or in your lifestyle or your life, such as getting a little bit older, that would change your risk reward profile that works for you. The next thing is to do the bear market math. So I call this the stock drop factor. We know that bear markets in the past have dropped 50, 60%. Look at the amount of money that you have in the stock market, multiply it by 50%. Could you handle that kind of drop, and could you bounce back from that? Usually the market recovers within a year, 2, 3 years after a bear market, but you know, it's not easy to go through that. So make sure that it's something that you can live with. So check that out and make sure that it works for you, so that you don't panic and you're not miserable when we do enter another bear market. The next thing I'll mention is to let facts be your guide. A lot of people make emotional financial decisions because it is so dear to our heart. It's so important because of our the needs that it fulfills for food and shelter. You know, we need our money, right? And so we can live and make decisions from our emotions. Usually that's influenced by investing mistakes, or more so from early childhood experiences around money, our family beliefs around money. And so instead of making decisions from emotions, look at the facts. How much has the stock market dropped in the past? How often has it gone down in the past? How long until it recovered? Does it go up more than it goes down? And it actually does. Be realistic about where you are and what sort of risk you have, whatever it is that you're doing. And then the last thing I'll leave you with is consider diversifying outside of mainstream investing. You know, there are plenty of other types of investments besides just stocks and bonds. There's real estate, there's master limited partnerships or MLPs, there's REITs, there's oil and gas properties, there's small business that you can develop yourself or you can buy into, which there are some real rules around that. So that's something that you'll want to learn about before you consider. But so many people now can start their own business, as we have done, online at a very low cost, and it becomes an asset over time and generates income as well. That's what I want to share with you in these videos, these ways to lower investment risk. And come see me at retirecertain.com. Be sure to grab my ebook over there. And I appreciate your watching. I hope this was helpful. Thanks.